Prices have risen substantially over the years. Rising prices have a noticeable negative impact on consumers, but inflation can be quite profitable for investors who know how to take advantage of it. Inflation is the sustained rise in the price of a certain basket of goods that includes many commonly purchased items. The average price of a loaf of bread in 1980 was 50 cents. In 2021, a loaf of bread costs $2.12. That is a 324% increase. Inflation reduces the purchasing power of a country's currency. Over time, you will be able to buy less with the same amount of money. While financial experts regularly debate the causes of inflation, the net effect on both consumers and investors is a rise in prices. Welcome to the Seth Rain Money Guide, where we teach you key money concepts to help you start your journey towards financial freedom. In today's video, we'll be talking about 5 different ways you can invest your money to fight inflation. Before we begin though, please be sure to subscribe to the channel and hit the notification bell. There are new videos being released weekly, and we don't want you to miss a single one. Also, keep in mind we are not financial advisors. We are just sharing our opinions regarding finance with no guarantee of gains or losses on any investments. Please always consult a professional financial advisor before making any major financial decisions. Now let's get started. The key to making money during inflationary periods is to invest in assets that rise in value at a pace that is higher than the rate of inflation. When it comes to investing your money during inflationary periods, here are 5 types of investments you should consider. Number 1. Gold and the gold industry. During periods of high inflation, investors are more likely to buy gold, which pushes up the price. Other precious metals, such as silver, also rise in value. Gold, on the other hand, is the one precious metal that seems to receive the most media coverage. Gold can be purchased and held directly through investments in jewelry, gold coins, or even gold bars. However, keeping a significant amount of gold can be difficult and risky. Rather than keeping physical gold, there are mutual funds and exchange-traded funds available that specialize in gold and the gold mining industry. This gives you the advantage of having a professional investor assist you with your investment decisions. You might also want to consider just investing in the stock of a gold mining company. Keep in mind though that gold is only marginally useful in the industrial world. Also realize that there is far more gold being stored than could ever be used for any practical purpose in the future. The value of gold is primarily influenced by the sudden desire of investors to own it. Number 2. Oil and other commodities. The price of oil moves with inflation. The price of oil impacts the cost of gasoline and many other commodities. Remember that many goods are transported by gasoline-powered vehicles. Oil is often attractive to investors because it directly impacts so many other products. Certain commodities, such as corn and other crops, require fuel in order to be processed. Oil is also used in the production of many other materials such as plastics and lubricants. Many commodities, like orange juice and cotton, will also climb in price when oil prices rise. Oil and related supplies are significantly more challenging to own directly than real estate and gold. While you might be able to stick $10,000 worth of gold under your bed, 100 barrels of oil or 100 bushels of corn is a lot harder for one person to store and sell in the market. It is far more convenient and easier to simply invest in an exchange-traded fund, also called an ETF. This type of fund will own the commodity, invest in related industries, as well as invest in futures and swaps. You can also invest in futures yourself. You can purchase stocks that will benefit from a rise in the price of the commodity. Consider not only those companies that benefit directly, but also companies that benefit indirectly. Number 3. Real estate investments. Real estate is also an appealing investment during inflationary periods. The value of property tends to increase when inflation rises. Property ownership during times of inflation increases the opportunity to experience higher rental income. Rents are subject to inflation, which is another appealing characteristic of real estate. Rental income often rises in response to the price jumps of goods and services in the marketplace. Of course, you can simply invest in a rental home or apartment building, but another option that doesn't involve owning any real estate directly is a real estate investment trust. A real estate investment trust, also known as a REIT, is a company or trust that specializes in investing in real estate and real estate mortgages. A REIT is priced similarly to a mutual fund and shares many of the same features. Number 4. Stocks. Stocks can also serve as an effective hedge against inflation. Most companies are able to effectively pass on inflationary expenses to their customers. As a result, stocks have the potential to keep pace with inflation. However, keep in mind that certain stocks are better than others for this purpose. For example, people are likely to continue buying diapers and toothpaste at the same rate they did in the past, regardless of inflation. The same outcome is most likely not true for luxury items. It's a simple fact of wants versus needs. On the other hand, fixed income investments such as certificates of deposit, bonds, money market funds, and fixed-rate annuities tend to suffer during inflation. When inflation rises, interest rates tend to climb as well. When interest rates rise, existing bonds become less appealing to investors. New bonds, on the other hand, are priced to reflect current interest rates. Number 5. Inflation index bonds. Investing in bonds indexed to inflation is another approach to keep pace with inflation. Treasury inflation-protected securities, also called TIPS, are an example of such an investment. Treasury inflation-protected securities are a type of Treasury security issued by the U.S. government that is tied to the Consumer Price Index. The value of the investment rises to match inflation. The value of the bond not only rises in value with inflation, but it also pays interest on the base value of the bond. The interest payment increases with inflation, which increases the underlying value of the bond if you ever choose to sell it. TIPS are available with 5-year, 10-year, and 30-year maturities and can be bought directly from the government through the Treasury Direct system in $100 increments with a minimum investment of $100. If you're interested in this type of investment, check the video description below for a link to the Treasury Direct website where you can purchase TIPS. There are other inflation index bonds available, and many other countries have similar types of investments. Inflation index bonds are not too well known among investors, but can be a useful instrument for individuals looking for consistent investment income. Many of these can be purchased directly from the issuer. They can also be obtained via a brokerage account or through the investment in some mutual funds and exchange-traded funds. Strongly consider keeping part of your investment portfolio in inflation-fighting investments. Talk to a professional financial advisor about incorporating these types of investments into your diversification strategy. One of the keys to successful investing is the ability to profit in all economic conditions. These 5 primary inflationary hedges not only protect your investment capital, they also provide the opportunity for it to grow and prosper. Well, that's all we have for today. If you enjoyed your time here, go ahead and hit that like button. Comment below of ways you are investing to help beat inflation. Please subscribe and stay tuned in the future, as we will have more great videos about money and how you can make it work for you. Take care. We hope to see you again real soon.